Hey Rick,
Hey Megan, happy Tuesday.
happy Tuesday. That's a good angle that you're at right now. You know how last week I said there was a little bit of blurry? This week is good.
Yeah, better.
Maybe it's getting the can lights in the
The lighting
screen
right.
versus not getting the can lights. So good job, Rick. I
Good
see you're
idea.
wearing your t-shirt, so things are good.
It's a good day.
Your your
Got my lights on, the t-shirts
uniform.
on, we're all good.
Yeah, your uniform. Okay. So we talked earlier about what we thought we could review today, and we
hmm
love educating people. That's what we're doing. This is why we're doing this.
hmm
This is going on, I don't know, 3 years of our weekly podcast. So um, we have three words to go over with everybody today. And these are three words that when you're buying a house or you're selling a house, you're going to hear these words. You're going to see them on your closing statement. You're going to talk about it. I'm going to talk
hmm
about it. And these three things, they sound the same, but they're not. So we want to educate you on a couple things. So I'll do, why don't you, okay, so the three words are homeowners insurance, home warranty, and mortgage insurance. Those are the three words. It
Yep.
sounds very confusing. So if you're a buyer, you might see mortgage insurance on your closing statement, but you might not see home warranty on your closing statement. So we're going to go over these real quick, that there's three
hmm
different things completely. So when you
Yep.
see them, you will be less confused.
Sounds good to me.
All right. So how about I'll do homeowners insurance, you do mortgage insurance, and then I'll do a home warranty. How's that?
Warranty? Perfect. We can do
Okay,
that.
perfect. Okay. So the first word is homeowners insurance.
hmm
And so that is your insurance that you pay on your home to insure it against, fire and theft and
hmm
major, issues that come up. And so that's your homeowner's insurance. And typically there's a premium, which is a one whole year of payments. Isn't that what a premium is, Rick?
It is.
So
It is.
that's when we say the word premium, that's the one whole year. This is what the insurance is going to cost you for a year. And typically, if you have it impounded, it's taken out monthly from, your account, but then your bank pays the premium,
hmm
probably
That's
once or
comes
twice
through.
a year.
hmm
Yeah. And so that's your homeowner's insurance. Now, a homeowner's warranty is something that you can buy as the home buyer, or the home seller can buy you a warranty. And the warranty says it's usually from sort of like um, right where the house is in, like it doesn't cover things that are go out towards the street, like your sewer and everything. But
hmm
your home warranty would typically for a year cover things that come up after the close of escrow that might be covered under their contract, things like ceiling fans, garbage disposals, AC condensers,
Full
dishwashers,
equipment.
that sort of thing. Yeah, pool
hmm
equipment, that's right. You can get add-ons like the pool equipment, you can get an add-on like a roof, that sort of thing. But a lot of times people are confused about what their warranty covers. So while you're in escrow, like you don't have enough things to do, you can, look up and see if the warranty company that your realtor has typically, or the seller has recommended that you use. You can do a little research and see if they are a highly recommended home warranty company, because
There you
you
go.
know sometimes people do a home inspection. I have heard it so many times, and like the water heater looks like it's about to rust and fall into dust, and I hear the realtor or the home inspector say, oh, if you get a home warranty, that should cover that. It's like so silly. Home
Mm.
warranties don't cover existing problems.
Pre-existing.
Yeah. And so and they'll look at your
Inspection report?
inspection, yeah, to
hmm
see if you were already warned about this. So anyway, so get it straight. Homeowners insurance is your insurance that is required by your bank for you to have that covers liability. If somebody trips and falls on your property, it covers if there's somebody, you know, if there's a fire. And a home warranty covers after you close escrow for about a year, whatever you negotiate, things that break, such as dishwashers, that sort of thing. But always read your policies for all these things before you assume something's covered.
Right. There can be things that are excluded for sure. You're not careful about that.
Yes. Like dogs, certain dogs could be excluded from your homeowners.
Oh, that's a good point. Yes.
Yeah.
Good point.
You got to
Yep.
read all the fine print. Okay, tell us about what the mortgage insurance, what
Mortgage
that
insurance.
means.
Yeah, I get this a lot. And I know that people don't want to pay mortgage insurance. I totally understand it, but let's look at what that is and why it's important. Mortgage insurance is for buyers that have less than 20% down payment. Okay, and why do you have mortgage insurance? Well, the mortgage insurance companies insure the lender. Now, this is instead of insuring the homeowner or the buyer against something, the PMI company, private mortgage insurance, is insuring the lender against loss in case the home goes into foreclosure. That's what PMI does. So what PMI does is it covers a percentage of the loss, if there was a loss, as a result of a foreclosure. That's what PMI does. That's what mortgage insurance does. So I know that people don't want to pay that. I understand it. But the reality is that if there was no PMI around or mortgage insurance around, you would have to have a 20% down payment on every home you buy.
Right.
And so mortgage insurance serves a very good purpose. And we talked about this before. The good thing about mortgage insurance, it's not permanent. It does not have to be forever on your home. At a certain point, you're going to be able to remove that mortgage insurance. So it's not forever.
You want to hear a funny fact?
Sure.
Tim and I'm thinking about it. We have bought maybe, I don't know, 8 or 9 or 10 houses, something like that over the course of the years. Bought some, sold some to buy other ones, that sort of thing. And I don't think we ever had 20% down or more unless we were putting the proceeds from another house into it. Like we did a 1031 exchange and that sort of thing. So we've never put a big down payment out of our pocket because you know, it's hard to get cash in your pocket, and mortgage insurance, you know, it's pretty reasonable. And like you said, you know, it's going to be on there for a couple of years. How do people get rid of mortgage insurance now? I know over the years it's been like, 2 years, or what's the procedure now? Just curious.
Well, yeah, it's a great question. There's a couple ways. The good news is, well, first of all, all the loans we did back during the pandemic, when rates were around 3%. And people have had 5% down, 10% down in those cases. Those houses have all gone up in value a ton. We know that, right? So after they've been in the home for 2 years, if there's a question about this, call me. I'll walk people through this. It's not hard to do, but I can walk them through the process. All you have to do is notify your existing loan servicer that you want to remove your PMI. They will do some sort of a home evaluation. And if you can verify now that there's 20% equity in the property, they can apply to have the PMI removed from the monthly payment. You can take it off the payment at that point without having to refinance. People think you have to refinance your house to pay off the mortgage insurance or to get rid of the mortgage insurance. That is not the case at all. The second way to do it, let's say, for example, where rates are today, when rates go down next year, and they will go down at some point, can't tell you when, but you know they're going to come down.
You know,
when that happens, I know. Listen, everybody's got that wrong so far. The smartest money in the country has missed that mark by quite a bit.
I know.
So it will come down at some point. But let's say for the buyers that have bought a house in the past year or so, within the next year or two, as the rates come back down, at that point, we can actually refinance the house to a lower interest rate. And then they'll have more equity. And at that point, the PMI comes off.
Yeah, that's easy.
So in that case, you're lowering the payment. Yeah, so in that case, you're lowering the payment through a lower interest rate and taking off the PMI.
I love
so
that.
You
always have such great critical thinking skills when it comes to that sort of stuff, you know, especially, you know, like if people don't want to pay, but they want to pay points to buy the rate down. I mean, there's like so many things to sort of measure out.
Yeah,
Will
you have
this
to
be
calculate that
worth
out.
it? Yeah,
Yeah.
yeah. So,
And if you
okay.
look at the cost of PMI is not that expensive. And by the way, all the PMI companies in recent years have lowered their premiums. So
Yeah,
it's not a big deal. It just
right.
honestly isn't. And when you consider how much you're going to build up in equity over a period of time, instead of
Hmm.
trying to save that extra money for the down payment,
I know. Well,
it's a
that's the
huge
whole
benefit.
problem. You can't save, you can't
You cannot
outsave the
save it.
market
You can't.
for 5 years now. For 5 years, you cannot outsave the market.
Yeah. If
Probably even
someone's,
6 years.
oh, for sure. So if someone came to us, let's just say 4 years ago and said, well, I don't want to pay PMI. I'm just going to save another $20,000 or $30,000 more. And when they get that 30,000 more, won't have the PMI. Well, okay. So that takes them 3 years to save that 30,000. Now the house they could have bought is $200,000 higher in
Hmm.
cost, and the rates are
Hmm.
higher. So instead of
Yeah.
spending $110 a month for PMI,
Yeah.
so you cannot out save the rate of
Yep.
appreciation, and not to mention tax benefits.
Absolutely.
So
Absolutely.
PMI is a great value.
Yeah. All right. So hopefully everybody understands now homeowners insurance, mortgage insurance, and a home warranty. Those were the
Warranty.
3 things that we covered today. And hopefully somebody goes, oh, okay, I get it.
Good stuff.
All right, Rick, I appreciate you. Have a wonderful rest of
Thank
your
you.
week.
Appreciate you, Megan. You
Keep up the
too.
great work, and we'll
You as
see you in
well.
1 week.
We'll talk later. Take care, Megan.